Hello and welcome to Connected with Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Becky Critchley, a financial regulatory lawyer and counsel in Latham & Watkins' London office. In this episode, we're going to discuss the key developments relating to the regulation of wholesale markets that happened last year, as well as the focus areas for the year ahead. To discuss these topics, I'm joined by my colleagues from the London office, Rob Moulton and Nicola Higgs. Rob and Nicola are both partners in the financial regulatory practice who follow these topics closely. Rob, Nicola, welcome to the podcast.
Hi, Becky. Great to be here.
Hi, Becky. Thanks for having us. There's a lot to chat about in the context of the UK regulatory agenda for 2025.
So, last year was busy in terms of reform in wholesale markets. Rob, will this year be similar? And what impact will the new government have?
I think it will be similar, Becky, and I say that because not only do we still have some measures from the Edinburgh reform agenda, which are still ongoing, but we have the new Mansion House reforms, which have picked up some new measures and started new consultations. And so 2025 will therefore be busy both trying to finish off some of the Edinburgh measures and pick up and start some of the Mansion House ones. Whereas you might have thought it possible 2025 would really just be finishing the first of those. Whereas we now have a new government who wants to make further reforms. And so that will drive a lot of work, I think, in 2025 and make it similar. It could be in a year's time, we are looking back on what measures are still outstanding from Mansion House in the same way as we're thinking at the moment what measures are still outstanding from Edinburgh. I mean, one example of that, some of the new consultations on making alterations to MiFID, we may get into that in more detail, but that's a major area. You can't make quick amendments to MiFID. And so that is a topic, I think, that will rumble all the way through 25 and very probably into 26 and continue to drive change for clients as they try to keep up with the new government's approach.
So it sounds like there are lots of changes still coming on MiFID II. Nicola, do you think these will be fundamental changes for firms or just some tweaks around the edges?
Yeah, thanks, Becky. So for us regulatory lawyers, MiFID II forms the backbone of the regulation that we advise on, and certainly the regulation that governs wholesale markets. So to some extent, any reform in that area is notable and something that garners very heavy industry engagement. But the government and the FCA have done a great deal of work already amending, repealing and restating parts of MiFID II. So the reform agenda has been ongoing for some time. In terms of their next stage of work, the real focus will be on transaction reporting and to a lesser extent on some of the MiFID delegated regs on organisational requirements. And so specifically on transaction reporting, during the first half of 2025, we are expecting an FCA consultation. And based on the indicators that the FCA has already put out to the market on its discussion paper, we're anticipating that there's going to be quite significant changes to that regime in the UK. So significant divergence from what we've seen under EU MiFID, perhaps. Couple of teasers on that. We're expecting an extension of scope of that regime beyond MiFID firms to require transaction reporting by AIFMs and UCITS managers. We're expecting a fair bit of simplification in the eyes of the FCA. So simplification on the types of instruments that must be reported, dropping the use of things like ISINs for certain types of OCC derivatives, removing the requirements for systematic internalizers to submit instrument reference data. And so the FCA's general goal seems to be this concept of simplifying the transaction reporting regime and improving the quality of data that it has to help it with its supervisory functions. But just from a practical perspective, what we do know is that whatever changes that may be likely to result will always be a major IT project for firms. And to date, a lot of firms have been able to implement for transaction reporting on a pan-European basis, including the UK. And so if we start to see some operational changes in the UK, that could end up being rather a heavy lift implementation project, notwithstanding the regulator's goal of simplifying the regime. And then in terms of the operational and organisational requirements, MiFID's focus in those areas is really the sort of the flesh and bones of compliance policies, governing things like conflicts of interest, general compliance, risk management, internal audit, senior management responsibility, PA dealing. So we're expecting sort of lighter touch changes in those areas, just tweaking around the edges, but something that will have, a trickle effect through internal policies and procedures, and firms will need to work through those changes throughout 2025.
And Becky, if we think about how those two topics overlap, you've got some of these reforms coming out of Edinburgh, like finalising changes to the prospectus rules or finalising changes to the investment research rules beyond the additional payment optionality, or changes to SMCR. And they're quite important structural things. And then suddenly overlapping it, you're in the nuts and bolts of transaction reporting. I agree with Nicola. Any simplification in the long term to transaction reporting is a short-term pain. And that, I think, was one of the things we learned from Edinburgh, and that the government may learn from Mansion House. If they want explicitly to say there are too many rules, let's get rid of the ones that don't matter, they'll have to win the industry round to the long-term benefits of that approach, because there'll always be a short-term hit. I mean, the MiFID Orgred, the nuts and bolts, the flesh and bones, as Nicola put it, conflict management, best ex, client categorization. These are all fundamentals where probably firms thought this is too complicated at the time it was brought in, but there's no obvious benefit that overrides the short-term hit sometimes to wanting to improve them if it's sort of going back to the future.
Really interesting. Thank you both. And so we touched on SMCR a little bit there. So Rob, what about that and any other changes announced by the Chancellor to the financial services regime?
Well, SMCR is a really interesting one to me because it seems to have been delayed so long. I rather thought, Becky, we might today be talking about the detail of the proposals, but it has taken time for the regulators to get to being able to say, what do they want to do, for example, with SMF7s, head office senior managers in effect? What do they want to do with the certification regime, as announced at a Mansion House, some sort of simplification and replacement to the annual certification regime? So I'd say that's one area that we still have this overhang. Another very important set of changes may have come anyway, but certainly driven with the sort of new government agenda, is the changes to the remuneration regime. We had the bonus cap go, and then last year, the reduction in the length of deferral periods, reducing the number and the simplification of the material risk taker regime, and so on. The FCA has matched those PRA proposals for dual regulated firms. I can't help but think part of the lobbying on the proposals will be to ask them to match them for solo regulated firms too. But it strikes me those are really important changes to the way that wholesale markets work. The remuneration rules post-financial crisis have been a major project for firms and everyone to get used to being paid like bankers. And so changes in that area be very important going forward. As announced at the moment, looking like they'll kick in for firms with a calendar year end for 1 Jan 2026. So they've all got to be settled next year to enable that to occur.
And so it sounds like a lot of this is then driven in terms of priority by the government's agenda. So what have we learned about the government's approach so far, and anything to note from the new City Minister?
Yeah, thanks, Becky. It's been really fascinating to watch the ambition that the new government has come out with for the city. We've heard the government define economic growth as the national mission, and the growth and competitiveness of the financial services sector in particular, which it describes as the crown jewel of the UK economy, as key to achieving that mission. And so what is clear is the government is very focused on both its own and our regulators' role in achieving that growth and competitiveness agenda. So, with that in mind, I think it's fair to say that the government is focused on reform in the context of certain overly conservative regulations that were brought in almost as a knee jerk reaction post the financial crisis. And during 2025, we'll see its first ever financial services and growth and competitiveness strategy. And that's going to focus on 5 priority growth opportunities for the UK financial services sector, being fintech, sustainable finance, asset management and wholesale services, insurance and reinsurance, and capital markets. What we also know is that the government will be outward looking in terms of its focus on global relationships, and in particular looking to strengthen ties with the US, as what the government describes as our single most important destination for financial services trade, as well as resetting the UK's relationship with the EU. So to summarise what we expect from the new government, we know it wants a more pragmatic regulation. So it'll be interested in the Trump government's potential agenda of deregulation, but also it wants a world-class regulatory framework and a stable regulatory framework. So it want to keep pace with policy in the EU and not lose touch with that. So in practice, therefore, I think we'll start to feel a UK regulatory policy straddling the Atlantic and aiming to take the best of both approaches.
What I don't think we've seen yet from the government is real heavy content on what they want to repeal. We've heard some statements about what they want to try to achieve, but if I had to draw a contrast between Edinburgh and Mansion House, Edinburgh is a list of areas where reform was overdue or repeal was being considered. And we hear about simplification, but we don't yet have a real working list of areas to look at. I mean, I don't know, Becky, whether you get a better sense about that, but I wonder whether we're still short of a real, here's the to-do list that matches the rhetoric.
No, I'd agree with that. I think what I'm hearing from you both and from what I understand myself is that Mansion House is the new baseline, but it's still to an extent underpinned by some of the reform announced by Edinburgh. So Rob, with that in mind, are there any important measures for wholesale markets that are still outstanding?
Yeah, so quite a few. I mean, some of them are nearly done. Prospectus final rules first half of this year as really the final piece of the jigsaw of a really big piece of primary market reform. And that led the way. That's sort of the poster child of the Edinburgh reforms. Not quite done, but nearly, but an important bit still to come. Investment research, again, part of the very important focus through Edinburgh. And we've had the changes now to additional payment optionality. But what we don't yet have is follow through on the other proposals, things like access for retail and a research portal. We've had references in Mansion House to these things, but we haven't yet seen the action on them. And so we need to assume that we will get that this year because it's still outstanding from Edinburgh. I think some very important changes to the PRIPS regime for disclosure, and that's important for wholesale as part of the chain by which those products are manufactured and distributed. And in some ways, it's slightly disappointing we haven't made more progress there, because that's a regime that everyone has agreed isn't fit for purpose, but which has proved difficult to reform in the way that the authorities would like. And SMCR, as mentioned, looking at whether the regime can be improved, where we are still awaiting, and have been for much of this year, changes that we mentioned a few moments ago on SMF7s, and a newer proposal around the certification regime. And so I'd say those are some key areas of work that 2 years on from Edinburgh, we're still waiting to be finished, and that need to be integrated into the reform agenda from Mansion House.
Great, thanks, Rob. That's really interesting. And so, Nicola, one of the key questions I think we get asked a lot is in divergence from Europe, and you touched on that in relation to the transaction reporting regime. So do you think we can still continue to think about the UK and the EU regimes as being broadly equivalent?
Actually, Becky, I think we'll remember at the dawn of 2025 as the point in time where we as practicing lawyers really had to start paying very close attention to divergence and recognizing the difference between the UK and the EU regimes. And sometimes the small nuances make the biggest of changes. And so it's certainly something that in our practice, we're very focused on at the moment. We're really starting to sit further apart from Europe, especially in the context of the UK repeal and restatement exercise. At a macro level, we often see policy objectives in the UK and the EU being stated as the same. The overtones on growth and competitiveness are the same. The overtones on consumer protection are the same. But what is evident is that even when the reforms pursue common goals, the outcome in the detail is different. So the mood music on the one hand is that the FCA and the PRA are starting to have more informal coordination meetings with European counterparts. It's definitely part of the government strategy to stay very close to Europe, but there's just a reality rule at play. We're no longer in the room in terms of European policy making. And when you're not sitting in a room together drafting new policy, you naturally end up with a regime that diverges. So I think we'll continue to see divergence, intentional or not, across many of the different areas that we practice in the financial services arena. I think one other notable point in the context of divergence is change can be different because you're focused on different policy priorities. Change can also just be different because it comes in at a different time. So what I mean by that is the pace of change can really influence where we end up. So it may well be that the UK wants and has a goal to achieve something that Europe is also setting out to achieve from a policy objective. But in doing it or implementing it 3 years later, not prioritizing it, they end up in a different place because the UK's judgment gets informed by other things it's seen in the world. And so we've seen the EU be incredibly ambitious in terms of its ESG and its sustainable finance strategy. We see the UK government and the UK regulators expressing absolutely the same ambition in terms of being a leading jurisdiction for sustainable finance and the ESG agenda. But what we also see is a slight wait and see approach by the FCA in terms of wanting to be globally competitive and relevant and seeing what other jurisdictions do first, as opposed to wanting to be the complete trailblazer in the context of ESG. And then you see other areas where the UK is really prioritizing and enjoying the flexibility of being nimble and not working as part of a large European machine that has to negotiate with a bunch of other member states. And I think most pertinently in the context of capital markets and the listing reforms, we've seen the UK be incredibly nimble in starting to diverge from some pre-existing European policy. So divergence is definitely the order of the day.
So maybe there might be, at the end of the day, some positives from Brexit if it helps the UK advance its competitiveness and growth agendas. I guess we remain to see whether that is the case. And so moving on to the end of the regulatory process that no one really wants to turn their mind to, enforcement. So Rob, are we seeing any trends in enforcement in the wholesale markets at the moment?
I don't know, I'd say it was a new trend, Becky, but I do see two trends. They've probably been around for a little while. But what conversations do wholesale firms not want to be having with the FCA or the PRA in 2025? I see one strand of that as being anti-money laundering controls. Not that money has been laundered, that would be bad on its own, but whether or not money's been laundered, how are your controls? Are you up to date with your risk profiling and so on? Have you got the records that you need? And the other one, very much in parallel, I think, second trend being market abuse surveillance. Again, not that insider dealing has occurred, that would be bad, but whether it has occurred or not, can you show that your systems are ingesting the right data, producing decent MI, are calibrated sensibly, that you don't have a backlog of alerts to clear, and that the process for producing suspicious transaction reports for regulators is working? Because those are areas that they really care about and where you can see the enforcement action.
And Nicola, do you think that will be the same for the regulators' enforcement plans for the coming year, or do you think they'll be different?
Well, we're all watching with bated breath the next enforcement that gets launched by the regulators, and that is in part due to the enormous attention that the FCA's proposals to announce the launch of enforcement investigations at an early stage garnered throughout the course of 2024. It was probably one of the most highly controversial proposals that I've seen in my career come out of the FCA, both amongst industry, but also amongst government, and ultimately culminated in a very uncomfortable evidence session before the House of Lords Financial Regulatory Committee for the FCA at the end of 2024. So in terms of sort of future enforcement outlook, until very recently, we were wondering whether the FCA might look to completely put those announcement of enforcement investigations plans on hold, or at least on ice, and wait for the dust to settle and think a little bit more carefully about how it would bring in that regime. But it has now relaunched that proposal and made some significant changes in terms of providing firms notice before announcing the launch of enforcement investigations, and running firm-specific impacts assessments before deciding to make public announcements about the launch of enforcement investigations. But I still think, in light of all of that pressure that proposal received and all of the critique it received, it will now be a very brave decision on the part of the regulator at any point in 2025 to utilise the power it's looking to give itself. And so, will it really just be in very extreme cases? And it may well be that in future we don't see this power being used very often, if at all. But that is certainly the key spotlight that is shining on any new enforcement that's coming down the pipe.
Thank you. And perhaps that an example of the relationship between the new government and the regulators and how that might work going forward. Rob, Nicola, thank you for joining us today to talk about the key trends in wholesale markets.
Thanks, Becky. I've really enjoyed it.
Thanks for having us, Becky.
There's certainly a lot for firms to be thinking about during the year ahead, both in terms of regulatory change and growth, and really embedding existing approaches and trying to get to grips with new approaches and perhaps regulatory divergence, both across the EU and between regulators in different areas. And thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Spotify, or wherever you get your podcasts. If you'd like more information about these topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time. And please stay tuned for our next episode on retail markets.
Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.